All right, today we're going to tackle a question that, let's be honest, so many of us have. What is the smartest way to invest your money? We're going to go way beyond just what to invest in and really focus on the secret sauce, how to invest. So let's get right into it. I mean, does this sound familiar? You've got some cash, maybe a bonus from work, and you know you should be investing it. But then you look at all the options and it's just overwhelming, right? Where do you even begin? Okay, here's the thing. Most people, most articles, they're all focused on where to put your money. You know, which stock, which fund. And yeah, that's important. But the real secret, the key to actually winning at this long term, it's not the where. It's all about the how. And that how is precisely what we're going to break down in this explainer. We're going to walk through 4 completely different paths, 4 really smart strategies to get your money working for you. All right, path number 1, the lump sum investment. Now, I want you to think of this one like planting a fully grown tree directly into your garden. Bam, you're starting big right from day 1. So what does that actually mean? Well, it's pretty straightforward. You're investing a big chunk of money all at once in one single go. And the biggest plus here, all of your cash starts working for you and hopefully compounding from the moment you hit go. So when is this the right move? Well, it's perfect for certain situations. Let's say you just got a big bonus at work or an inheritance comes through. That's a classic lump sum scenario. It's also a really powerful move if you feel like the market is having a sale, when it's down. You get to buy in at a discount, which can seriously boost that long-term growth. But wait, I can almost hear what you're thinking. Isn't that, super risky? We've all heard that before, right? That putting all your money in at one time is a huge gamble. Okay, let's bust that myth right now. The risk isn't actually in the method itself. The real risk? It's investing without a plan. Doing a lump sum without knowing your goals? Yeah, that's like driving with your eyes closed. But if you have a solid, long-term plan, it's a calculated and incredibly powerful strategy. Okay, so let's switch gears to our second path, which is a totally different way of thinking. This is the systematic investment plan, or as you probably know it, an SIP. Now, if a lump sum is planting a full tree, an SIP is like planting a tiny seed and watering it consistently week after week, month after month. The SIP is probably the most popular way people invest, and for some really good reasons. It's so simple. You just commit to investing a set amount of money at regular times, say every month. It basically puts your investing on autopilot and builds an amazing habit of financial discipline. And here's where the real magic happens. First off, it forces you to make investing a habit. Second, you get this awesome benefit called Ruby cost averaging. What's that? Well, when the market dips, your fixed monthly amount buys more units of a fund. When the market is high, it buys fewer. It smooths out your costs over time, so you don't have to stress about trying to time the market. This makes it absolutely perfect for anyone who gets a regular paycheck. All right, on to path number 3, the systematic transfer plan, or STP. I love this analogy. Think of this one like you're a gardener, carefully getting a delicate plant used to the outdoors. You don't just throw it out there. You move it from the safe greenhouse to the main garden slowly, protecting it from any sudden shocks. Now, what's so cool about the STP is how it kind of gives you the best of both worlds, safety and growth. Here's how it works. Step 1, you park your lump sum of money in a pretty safe, low-risk fund, like a debt fund. Step 2, you then set up an automatic, regular transfer of small amounts from that safe fund into a higher growth equity fund. See what you're doing? You're easing your way into the market, which makes for a much smoother, less stressful ride, especially when things are volatile. And that brings us to our 4th and final path, the Systematic Withdrawal Plan, or SWP. This one is simple to understand. If an SIP is all about planting and watering, the SWP is all about harvesting. You get to enjoy the fruits of your labor, your fully grown tree, on a regular basis. It's literally the exact opposite of an SIP. So an SWP does exactly what it sounds like. Instead of putting money in, you're taking a fixed amount of money out of your investments at regular intervals. The whole point of this is to create a predictable, stable stream of cash from the wealth you've already built up. So, who is this for? Well, it's an absolute game changer for retirees who need to turn their nest egg into a monthly paycheck. It's also fantastic for freelancers or anyone with an unpredictable income who wants some stability. In short, it turns your investment portfolio into your own personal salary. Okay, so we've walked through all 4 paths one by one. Now let's do what we all love to do. Put them head-to-head in a side-by-side comparison. This is where you'll really see which one is for which situation. Let's kick things off with the two you hear about most, lump sum versus SIP. Lump sum, remember, is going big all at once for maximum compounding potential. And SIP is the slow and steady approach, investing small amounts regularly to build discipline and ride out the market waves. Totally different philosophies, right? For totally different goals. And here's the whole shebang in one handy table. You got a big chunk of cash? Lump sum. You're just starting out or earning a regular salary? In SIP is your best friend. Worried about market volatility and want to ease in? That's the STP. Need to turn your investments into a steady income? SWP is the way to go. It's amazing, really. There's a specific tool for every single financial situation you can think of. Okay, so now that you've seen the lineup, the most important question is, which one of these is right for you? Let's stop talking theory and make this super personal. Just think for a second. Is this you? Did you just get a bonus from work? Or maybe you've been saving up for a while and you've got this nice pile of cash that's, well, just sitting in a savings account doing nothing. If you just nodded your head, then the strategy for you is pretty clear. It's the lump sum. The idea is simple. Get that money into the game and working for you right away. Give it as much time as possible to compound and grow. Okay, let's flip the script. What if you're in a totally different stage of life? What if, instead of putting money in, what you really need is a predictable, regular income coming out of your investments? If that sounds like you, then the SWP is your perfect match. It lets you create that steady cash flow, just like a salary, while the rest of your money can hopefully continue to grow in the background. Phew, we have covered a ton of ground. But look, if you only take away one single thing from our entire chat today, please let it be this next point. This is the golden rule that pulls it all together. It really is this simple. You have to match your investment method with your personal money habits and, of course, your goals. The best strategy out there isn't some secret formula. It's the one that just fits. It's the one that aligns with you, your life, and what you're trying to build. So there you have it. We've shifted the focus from the where to the, I think, much more important how. You now have 4 clear playbooks for investing in mutual funds. The only question left is which one are you going to start with?